Good morning, everybody, and happy Tuesday. Today is December 5th, 2023. The top story this morning, Moody's has cut China's credit outlook, not the rating. That's an important distinction. They have cut China's credit outlook, citing risks surrounding local government debts. You may recall in this channel over the years, I've done a lot of coverage of China's housing collapse and the Evergrande collapse and now the Country Garden collapse and Vanka. You can add all the other developers in there. But all along, we've talked a lot about these LGFVs, or local government finance vehicles. And it looks like that's what is driving this downgrade from Moody's today. See, in China, the political structure is such that local leaders, regional leaders are under immense pressure to hit GDP growth targets that are handed down to them from Beijing. But at the same time, these local governments are given very tight restrictions on how much debt they're allowed to take off. And at the same time, almost all of the tax revenue goes from the local areas into the national government. So local governments are given very strict growth targets. They're not given the tools to hit them, and they're not allowed to take out debt in order to fund this massive economic growth. So what do? They do what any reasonable person would do. They create shell companies in order to pile up the illegal debt for the local governments in these shell companies, and then they use that debt to fund these massive infrastructure projects that it's questionable whether it's really needed or not. But as long as you keep building, as long as you keep pouring concrete and putting down steel rebar, it looks like economic growth, economic activity number go up, and everybody's happy. That has been happening for decades in China. And it hit really a fever pitch around 2021 when Xi Jinping rolled out the 3 red lines policy. Now, the 3 red lines policy was targeting the real estate developers like Evergrande and Country Garden. So when the developers stopped building the apartment buildings or slowed down because of the debt limits that were imposed on them, in order to maintain that GDP growth, the local governments actually increased their borrowing to create more work on infrastructure projects to offset the declines in the new building of apartments. And Moody's has finally said, guys, got to wave the BS flag on that one. It's become increasingly clear that you cannot pay back these debts. And so what are these local governments going to do? They're probably going to go hat in hand to Beijing and say, bail out, please. And it looks like this local government debt, these LGFVs, local government finance vehicles, it's starting to rear their ugly heads in a couple of different areas. Zhangji is one of the biggest shadow banks. It's a commercial lender. It's not a bank, but it behaves kind of like a bank. And they have lent a lot to these local government finance vehicles over the years. And we just heard last week that they are hopelessly insolvent. Their liabilities are triple their assets. So they have no hope of ever paying back their debt, most of which is to these local governments. And so Beijing has ordered China's banks to increase lending to try to bring that debt back onto the balance sheets of someone. Because here's the thing about this local government finance vehicle debt. Nobody knows how much is out there. We just don't know how much there is because it is held off balance sheet. It's not really all reported. It's not captured in any reports. Rumor mill says it's somewhere between $8 and $11 trillion US. Hardly a trivial amount. So that's the big news in China. China stocks are selling off. The People's Bank of China and Chinese banks are defending the yuan against the dollar, selling dollars to buy yuan to try to prop up the currency off of this news. Again, I just want to nitpick, guys. That is the credit outlook, i.e. the prospects for future changes to the credit rating. China's credit rating has not been changed, just the outlook on that rating. That is an important distinction. Also, we got U.S. factory orders came in yesterday. Pretty substantial drop. Factory orders in the U.S. dropped by the most since April of 2020 in the month of October. You may recall April of 2020 was a rather doo-doo kind of time for the economy. That was during the early days of the that shall not be mentioned. Well, factory orders are slowing. We've seen that theme playing out a lot this year. Inventories have grown because consumption is at least a little bit slowed. I mean, we're getting mixed signals from the economy about what consumption is doing. We had, Adobe and Shopify. Adobe and Shopify said Black Friday numbers and Cyber Monday numbers were great, and yet brick and mortar is kind of saying not really so much. But one thing is for sure, factory orders have been slowing. Inventory has been piling up at stores. So we're making more than consumers are buying, which means the orders are slowing. And you can see that there's less trucks on the road. Freight rates are down. Trucking companies are going bankrupt because the factory orders are slowing. And if we're not making the stuff, then you don't need trucks to take it from the factory to the store, do you? No, you do not. Now, I would also add that there was a big decline in aircraft orders. So I don't want to be too doomy and gloomy here over this factory orders number. Aircraft is a huge contributor to these factory orders numbers. And if you get a big order for aircraft in September and then you don't get a repeat of that big order for aircraft in October, which you wouldn't expect to, then you're going to see a big decline in factory orders. And it looks like aircraft did play a very big role in this decline in factory numbers. Whether or not that was the entirety of it, or is it masking a more across the board slowdown in manufacturing, that remains to be seen. And with that, why don't we shrink my big melon of a head and let's see what's going on in markets this morning. And guys, while we're shrinking my head, don't forget that like button. It really helps get this message out there. And if you're new to the channel, hit that subscribe button while you're here. We do this every morning. Have your coffee with the melon heads as we go through markets ahead of the opening bell. And the S&P is down again ahead of the open this morning, down 17 basis points or 0.38%. That's after being down yesterday. Watch that 4,600 level on the S&P, guys. It looks like we're stalling out right about that same level where we stalled out at the end of July. Is the market about to put in a big double top? Right now it looks like it, but I'm not ready to call that one yet. And the Dow is also down 129 points ahead of the opening bell or 0.36% lower for the Dow. And the NASDAQ leading the way lower this morning, down almost 70 points, 0.44% lower for the tech-heavy NASDAQ. Watch the Magnificent Seven, guys. When they go lower, they drag the whole market down with them. And the DXY is kind of all over the place this morning. Check out the moves in the Dixie. I suspect this may have a little bit to do with whatever is going on over in China and the Chinese banks defending the yuan. Now, the yuan is not an input to the DXY math. It's not included in that basket. But if you get Chinese banks dumping dollars on the open market in order to buy yuan, that will have secondary knock-on effects that will affect the dollar versus the yen, the dollar versus the euro. So it's possible what's going on here in the Chinese banks in response to the Moody's outlook cut could be causing some of the noise in the Dixie chart. Although right now it's pretty much unchanged, down 4 basis points at 103.67, but it has been up and down a couple of times so far this morning. Looking over at the bond market this morning, we got yields on the long end are lower. We have the 30-year Treasury is at 4.355. That's down 8 basis points this morning. And the 10-year at 4.2, down another 8.5 basis points this morning, yielding 4.201. Guys, remember, we were over 5% about a month ago. This collapse in yields, the bond buying that has happened in the last month or so has really been dramatic. And keep in mind the fact that right now institutions are piling into long duration bonds. This is important because remember Silicon Valley Bank, remember Signature Bank. They failed because they bought too many U.S. treasuries and then interest rates on those treasuries rose. The value of those bonds collapsed, and that caused losses on those securities. When those losses were reported, it panicked their customers, and their customers went to withdraw money, and the bank failed. And the reason I say that is because there's still a massive, somewhere around 650, it's probably a little less now, about $600 billion in unrealized losses on the balance sheets of America's banks. Well, right now, Wall Street is buying U.S. treasuries like crazy. Ever since the end of October, they have been piling into long-duration U.S. treasuries. They're adding to their pile of treasury bonds. Well, what happens if the Fed doesn't cut interest rates? What happens if the Fed doesn't start printing again? See, what the banks have done is they have increased their exposure. I don't know if this is banks, by the way. This is probably banks, hedge funds, shadow banks, insurance companies, pension funds, right? Wall Street across the board is buying these bonds here. But what they're doing is they're increasing their exposure to higher interest rates here. And they're basically putting a gun to their own heads and saying, yo, Fed, you better cut. Otherwise, we're all hosed. Because if this buying stops and if the march higher in interest rates resumes, as is mathematically guaranteed to happen at some point without Fed intervention because of the rate at which the Treasury is issuing bonds and the rate at which the government is running deficits and the lack of demand for them outside of this euphoria going on right now. If the Fed doesn't acquiesce, if the Fed doesn't blink in this game of chicken, Wall Street has just screwed itself with all of the bonds that it's bought over the last month. They've increased their exposure to this problem. So better hope they're right betting on this Fed pivot. And again, I'm not so convinced it's going to happen. Maybe they do, maybe they don't. But there is nobody out there entertaining the notion that what if they don't? What happens if the Fed doesn't cut in 2024? They probably will. Maybe they will. Maybe they won't. But nobody is asking, what if they don't? Jerome Powell does not want to. That's why I keep saying, if they get rid of Powell, if you see him replaced, fired, or stepped down for personal reasons, that means they're about to put some kind of an MMT dove in his place. That means they're about to start cutting. We've also got the 2 years at 4.622. That's down 3.5 basis points this morning. And the 1 month is at 5.397, unchanged as always. Reverse repo watch, guys. We saw a slight uptick in reverse repo yesterday by about $47 billion. Currently at $815.8 billion in the reverse repo. That's up off its lows of about 765 that we got a few days ago. So reverse repo still on trend, still working its way down, although it did take a little bit of a step change up yesterday. And in the commodity space, we've got gold. February gold futures at 2,043, well off its highs from yesterday. We peaked at about 2145, 2150 yesterday. Got quite a big slam down yesterday, although gold's still holding up pretty well, up $1 today, still over 2,000. So I'm not ready to throw in the towel on this run in gold just yet. But again, gold traders also doing the same thing the U.S. Treasury buyers are doing right now. They are betting that the Fed is going to lower. They're betting on more Zerpenber. Maybe they're right. Maybe they're not. March silver futures 24.78. That's down about 12 cents or about another 0.5% today. Silver also took it on the chin yesterday. We have got platinum and palladium are both down just under 2% this morning. And West Texas Intermediate January futures at 73.65. That's up about 60 cents or 0.85% higher this morning. And this is the top story here. Moody's cuts China credit outlook, citing lower growth and property risks. This one hit the tape while we were sleeping. Ratings agency Moody's cut its outlook on China's government credit ratings to negative from stable on Tuesday in the latest sign of mounting global concern over the impact of surging local government debt and the deepening property crisis on the world's second largest economy. The downgrade reflects growing evidence that authorities will have to provide more financial support for debt-laden local governments and state firms, posing broad risks to China's physical, economic, and institutional strength, Moody's said in a statement. And I have to take issue with this statement here. The downgrade reflects growing evidence that authorities will have to provide more financial support to governments and state firms. Why? Why do we always have to provide more financial support? I get it. These are government agencies, but when I screw up, nobody steps in and provides financial support to me. When somebody screws up, I'm sorry you screwed up. Eat your own screw up. Why is this? Well, the government's just going to have to step in and help. Oh, what's this? Wall Street over-leveraged itself and bought too many U.S. treasuries and didn't properly hedge interest rate risks? Well, authorities will have to intervene and provide assistance. Why? Let them fail. Let them fail. It sucks. It will be painful for certain individuals, yes, but where is it written that we must socialize each and every risk across the board? Socialized risk, privatized gains does not make sense to me. And there, get off your soapbox, Jack. The outlook change also reflects the increased risks related to structurally and persistently lower medium-term economic growth and the ongoing downsizing of the property sector, Moody's said. China's blue chip stocks slumped to nearly 5-year lows on Tuesday amid worries about the country's growth, with talk of a possible cut by Moody's denting sentiment during the session, while Hong Kong stocks extended losses. China's major state-owned banks, which had been supporting the yuan currency all day, stepped up U.S. dollar selling very forcefully after the Moody's statement. One source with knowledge of the matter said the yuan was little changed by late afternoon. Again, see also that noise in the Dixie chart. I'm not sure that's really causing it. Again, the yuan is not a direct contributor to the DXY. The cost of insuring China's sovereign debt against a default rose to its highest since mid-November. And now the markets are more concerned with the property crisis and weak growth rather than immediate sovereign debt risk, said Ken Chung, chief Asian FX strategist at Mizuho Bank in Hong Kong. And that's the rub right there, guys. Really, this all boils down to the property crisis and, of course, by default, weak growth. This is the China developers. This just keep building no matter what happens. Build another building. Hey, there's nobody that really wants to live there. Who cares? Put another building. Oh, here's a space right here. Put a building on it and then build a high-speed rail connecting the two buildings. That way, the same nobodies who don't live in the buildings cannot ride the train connecting the two buildings. That has been the growth policy in China for about 30 years. It's worked in some areas. It's helped propel China to the world's second largest economy. Whoops, now we've got tens of trillions of dollars in debt that needs to be addressed. And I would add, guys, China does not have the world reserve currency. When the U.S. was facing a multi-trillion-dollar debt bubble and a big collapse and the prospects of a deflationary death spiral, we printed money. And when we printed money, we stole value from the dollars that were held outside the United States all over the world because we're the world reserve currency. Everybody holds dollars. So we were able to steal from everybody when we printed that money to bail ourselves out. The whole world doesn't hold yuan. So China can't print their way out of this, not without destroying their own currency. So, if you're just saying, well, whatever, the government's just going to bail them out, understand they can't. They can only socialize the losses among their own people. They can't socialize those losses among other countries like the United States did. So it's not as easy as just Zerpenber for the People's Bank of China. It shouldn't be that easy for the Federal Reserve. It shouldn't be that easy for the U.S. Treasury either, but they won't be able to do that. And let's also talk about U.S. factory orders. This one hit the tape yesterday. Factory orders in the U.S. sank by 3.6% month over month in October of 2023. That's following a downwardly revised 2.3% rise in September and worse than market forecasts of a 2.8% fall. It is the biggest decrease since April of 2020 and a sign that the industrial sector is suffering from high interest rates and inflation. So people are ordering less stuff from the factories. Why? Because stuff is piling up on store shelves. We've seen a lot of talk of reducing inventory in a lot of the retailers' quarterly reports. People talking about right-sizing inventory. That means they're not going to order as much stuff to replace the stuff they're selling. They want to reduce how much is sitting on the shelves. Now, here's the rub in this report. Orders for transportation equipment sank 14.7%, namely non-defense aircraft and parts, which fell by 49.6%. So a large percentage of this decline in orders was clearly from non-defense aircraft, i.e. Boeing. All right, Boeing got big orders for jet planes in September. They didn't get the big order in October. So the fact that that big decline in non-defense aircraft, that's a one-off. It's not indicative of economic collapse or anything like that. It's making this number seem a lot worse than it really was. It's still not a very good number, but the aircraft thing is contributing to it a lot here. Orders also declined for electrical equipment, appliances, and components, down 1.1%. Machinery was down 0.3%. Primary metals down 0.3%. In contrast, orders rose for fabricated metal products by 0.4%. Computers and electronics rose by 0.3%. Excluding transportation, factory orders were down 1.2%. And excluding defense, orders sank 4.2%. Now, that's interesting, too, that if you take away defense, orders sank by even more. That means all this military spending is offsetting a decline in economic activity elsewhere. War is good for the economy. It's sad, but it is true. And here you go, negative 3.6%, biggest drop in quite a while in factory orders in the U.S. Again, partially that's being driven by aircraft, which is a one-off. And you can see the last time we saw anything like this way back here in April of 2020. And you can kind of see here in this chart, there is a subtle downtrend here. It's not a collapse. It's not falling off a cliff, but you are getting progressively lower highs and lower lows. So that's one to keep an eye on. And it looks like GDP Now is spotting it also. GDP Now is produced by the Atlanta Fed. It's a forecast on what the next gross domestic product would look like. The GDP Now model estimate for real GDP growth, seasonally adjusted in the fourth quarter of 2023, is now 1.2% in December. That's down from 1.8% in November 30th after this morning's construction spending release from the U.S. Census Bureau and the manufacturing ISM report on business from the Institute for Supply Management. The Now casts a fourth quarter real personal consumption expenditures growth And fourth quarter real gross private domestic investment growth decreased from 2.7 and negative 2.7 respectively to 1.8 and negative 3.2. So we've got less spending on consumption. Retail shoppers just don't have as much money as they used to. And we have got shrinking inventories in response to that. Both of those are hits to GDP. And as of this morning, the current forecast for GDP growth in the fourth quarter is 1.2% and falling. We'll see what this number actually comes out to. I suspect we are going to end up with a negative print when all is said and done. And lastly, guys, time to mention another glitch, if you will. London Stock Exchange suffers new trading outages. Small cap stocks affected in incidents that appear identical to the glitch in October. A lot of glitches going around here, guys. A lot of glitches. I mean, everything from the London Stock Exchange, Japanese interbank payments, ICBC, the 30-year Treasury auction, Mitch McConnell. Glitches are everywhere. The London Stock Exchange suffered 2 outages on Tuesday morning, hitting trading in hundreds of small cap stocks and marking the latest glitch at a venue battling falling trading volumes. Only stocks on the FTSE 100 and 250 indices and global depository receipts, a certificate representing shares in overseas companies, were able to be traded. The LSE first said it was investigating the issue at 9:29 a.m. with trading suspended in companies including online retailer ASOS, drinks maker Fevertree, and polling business YouGov. At 10:17 a.m., it said normal trading had resumed for affected stocks. Okay, so at 10:17, everything was fine. Well, that's great. But just over an hour later, the exchange suffered a second outage, hitting the same stocks again. This time they said, we are undertaking immediate analysis. Well, it's a good thing your analysis is not delayed analysis or a later analysis. This is an immediate analysis. So they're serious this time, guys. That's what they said at 11:35 a.m. The 2 trading failures in one morning mark yet another blow to the LSE, whose services are relied on by thousands of investors across the world, but which is facing tumbling trading volumes. And guys, I just want to add that you don't need to worry because we fixed the glitch. All right. When asked for a comment over at the London Stock Exchange, they just want you to know, don't worry, their immediate analysis, they fixed the glitch. Another in a long line of very suspicious electronic happenings in the world of finance, one after another. It's been going on for months, guys. Hey, I don't know. Do we want to put this thing on again? Do we want to get a little tinfoil hatty? Are we ready? Are we ready to talk about artificial intelligence and the role it's playing in all of these cyber attacks? By the way, I don't have any proof that this was a cyber attack on the London Stock Exchange. Maybe their systems just haven't been upgraded. But an awful lot of these very important systems that usually work pretty well are all starting to go down one after another. Are we ready to talk about artificial intelligence and the role it might be playing in this? No? Nobody? Anyone in the back? No? Okay. All right. We're going to lose the tinfoil hat then. No worries. Just seeing, just checking the pulse, everybody. And I want to say thank you very much to Mr. Wesley Rubel, who says, don't forget, FDIC wants banks over $100 billion to start buying long-term. That's why I asked about Fed QT and the long end of the curve. The FDIC wants banks over $100 billion to start buying long-term. Are we talking about long-term treasury bonds here that the FDIC wants the banks to start buying the things that caused the banks to fail back in March? Am I understanding that one correct, Wesley? Okay. I guess the FDIC is telling the banks that, hey, guys, the Treasury could really use your help in buying up those bond prices and bidding down interest rates, because the government's going insolvent. So if you guys could go ahead and step in and buy up our debt so that, you can loan the money to the government and we can spend it on unicorns and rainbows and say, look, my economic plan is working. That'd be great. Don't worry. We'll bail you out if and when you fail. That sounds like a very government-y thing to do. That's why he asked about Fed QT and the long end of the curve. I didn't catch the question about Fed QT, Wesley. But yeah, that does sound very much like a U.S. government kind of thing to do is, don't worry, guys, just go ahead and buy this thing that caused all this problems. We'll socialize the losses among the tax base. Not a problem. It does sound very much like your tax dollars at work. Thank you, Wesley Rubel. I appreciate the super chat, the support of the channel. And thank you to Thornton Mellon III. Whoa, And I see Mr. Dangerfield on there. I'm digging the name, Thornton Mellon III. Is that anything like Thurston Howell III? Is that who that was? Other than interest rate risk, what's the danger in owning TLT? Other than interest rate risk, I mean, interest rate risk is the real risk in owning TLT. I don't own TLT. I don't have any position in it myself. But that is the risk. I mean, that's the real risk is rates rising, sending the value of those bonds lower. A bet on TLT is a bet that interest rates are going to keep heading lower. I mean, yeah, there's the prospect of counterparty risk there, the institution. I'm not sure who the custodian of TLT is. Like any ETF, if the custodian of that ETF or if the institute that manages it, if they go bankrupt, the secured creditors will get paid first. See also The Great Taking in that interview I did with Mario Ineco from Ineco 64 a little while ago. There's a little bit of counterparty risk when you own an ETF. If that ETF goes bankrupt, you're last in line to get paid. TLT is no different than GLD or SLV or any of the other QQQs, any of those other ETFs. So there's a little bit of counterparty risk. If you want to own U.S. Treasuries, guys, just look into it. I'm not a financial advisor. I can't tell you what to do with your own money. I can tell you what I did. I started a Treasury Direct account, all right? If you want to buy U.S. Treasuries, why go through a middleman who is going to take a fee and add to the risk? Why not just start a Treasury Direct account and buy it yourself? It takes a few minutes. The user interface isn't really that good. It's kind of cumbersome and it's a pain in the butt. And, the password has to be 500 characters and contain 50 different letters, all that other. It's a typical government website, but you're saving yourself money and you're eliminating your risk when you do that. So just something to think about, guys. Just go direct to the source. Why add a middleman? I don't own any long duration U.S. Treasuries other than, I have money in the bank and the bank puts my money in U.S. Treasuries. So I guess secondary, I own it. But I own mostly just T-bills right now. I mean, why am I going to go buy the Magnificent Seven right now? Or why am I going to go buy the S&P, earn a couple of percent interest when I can get almost 5.5% interest for free on a 1 month T-bill at this point? So me, T-bill and chill, that's kind of how I roll at the moment. As long as the Fed wants to bankrupt itself with 5% interest rates, I am happy to be the beneficiary of that, especially since I'm ultimately going to be the one paying for that when the government either defaults on its debt and causes economic calamity, or when they hyperinflate to default on their debt that way. Either way, I'm paying for it on the back end. I might as well get paid on the front end. Thank you very much, Thornton Mellon III. That is a pinkies up kind of name. I appreciate the super chat, the support of the channel. Thank you, everybody, for having your coffee with the Melon Heads this morning. I appreciate that very much. Thank you to my Patreon supporters for everything you guys do for the channel. Link down below should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.